Hi, this is Louis Yanis, and this is the Market Call Show. Today, I'm going to be talking about the two primary ways that wealth is destroyed and how you can beat it. Taxes and inflation is ignored many times when people are looking at their financial planning, which doesn't make a whole lot of sense because taxes and inflation is so enormous. Let's talk a little bit about what inflation is. Inflation is a basket of goods and services that's measured to see how much prices move. And it's an index over time. Inflation is one of those metrics that is used by the Federal Reserve to gauge the health of the economy. Since 2012, the Federal Reserve has targeted a 2% inflation rate for the US economy. And they make changes to monetary policy if inflation is not within that range. A notable time for inflation was the early 1980s. During the recession back then, inflation rates went as high as 14.93%. That caused the Federal Reserve, led by Paul Volcker, to take dramatic action. Now, the US inflation rate now is at 5.25%. Now, that's above average. That long-term average has been 3.22%. And we're looking at statistics based from the Bureau of Labor Statistics. So that's just one of the thieves that take our money away. And just to put things in perspective, I ran some numbers. I got a spreadsheet and I took the CPI index, the consumer price index for all urban consumers. And I took the original data from the BLS. And I got that from 1913 all the way up to August of 2021. So it's a pretty comprehensive data set. And I said, okay, what does inflation look like on average for people if they hold, for their retirement, or if they're looking at a long-term time horizon, say 10 years, 20 years, or 30 years. And what you find is that it's amazing how much money you lose. Basically, your purchasing power is eroded because the inflation rate is so large. So it doesn't sound like much when you're looking at 2 or 3%, but actually right now, obviously it's running higher. But even if you run at the average, what you're looking at is some significant erosion of your dollars. So let's just look at some of these statistics on a 10-year rolling basis. So we're saying rolling 10 years, looking at all the stats there. On average, if you spend $1 now, 10 years later, you need to spend $1.31. So it's a 31% increase in how much money that you need to have. You need to have 31% more money just to stay even in a 10-year period of time. So if you look at it from a 20-year period of time, so most retirees, they have at least 20 years in retirement, it almost doubles. You need $1.80 just to stay even to your dollar when you first retire. And some people are, looking at a situation where they're 30 years or more in retirement, and you need $2.56 just to stay even. And that's just the inflation. When you take the tax part out of it, it's even more dramatic. So I want to switch a little bit of gears and talk a little bit about taxes. And then what I'm going to do is I'm going to talk about how to overcome these two thieves of our wealth, okay? I'm going to switch gears and talk a little bit about taxes. Winston Churchill, a very interesting leader, one of the things he said was so right on the money. He said, "We contend that for a nation to try to tax itself into prosperity is like a man standing in a bucket and trying to lift himself up by the handle." So one of the things that's driving the tax situation is that we just keep spending and spending and spending. So taxes are a big drag on your wealth creation. They take a chunk out of your money and they extend the amount of time needed to build your nest egg. Your goal and my goal is to reach financial independence as quickly as possible, right? And to keep it for the rest of your life. Anything that keeps you from doing that goal must be reduced or eliminated from your situation. So let's take a quick look at examples of how taxes affect your wealth creation. So obviously taxes slow down your wealth creation. Let's say, as an example, I calculated some stats for you. Let's say you had a $500,000 investment and you're in the middle tax bracket, which is 28% or so. If you're going to invest for 20 years and your gross return is 6% before taxes, you're really only going to earn 4.32% because you're paying taxes out of it, right? So that you multiply that 6% times 1 minus the tax rate and you get 4.32%. So that's a reduction in your average return of 1.68% per year. It doesn't sound like a lot, but let's take a look at what happens over a 20-year investment time period. I've already demonstrated this, by the way, with inflation, but this is in addition to that, above and beyond inflation. After 20 years, that taxable investment is worth about $1.16 million. That sounds pretty good. But if you compare that to what you could have earned if you invested in a tax deferred account, for example, that tax deferred account would be worth $1.6 million. So you could have increased your wealth by $439,000 just by selecting some tax deferred investments. That's a huge difference that can help you achieve financial freedom faster. So taxes do matter. So let's talk about the shrink in your future tax bite, because we know that managing your future tax bills is just as important as lowering your current ones. So taxes in the future could rise for the so-called wealthy because, basically we have irresponsible government spending. I think that's a very objective thing that we can say. If you look at the 2021 government spending projections, the total appropriation spending in the United States is about $4.79 trillion, according to the CBO, the Congressional Budget Office. Now, that debt burden in the United States right now is about $26.48 trillion. Okay. That's huge. That's according to the US Department of Treasury. Okay. So if you just divide that out, think about this. If you divide that out by each US citizen, that's about $80,000 per US citizen. And since I calculated these numbers have ballooned. And we have ballooning spending programs that will almost certainly increase, the cost of healthcare, Social Security, Medicare, et cetera. And it's not likely that that bill is going to get paid on its own. So government spending continues to become a large part of our overall economy. Somebody must pay for this. Who do you think is going to pay for it? That's the question. Who do you think will pay for it? Is it going to be the rich? Even if we tax the rich 100%, the rich cannot pay off all this debt. So we're going to have to go down the pay scale to the middle class in order to find the money. And we know that the middle class is paying a big part of this. So if we paid off the government debt, the deficit would still continue to grow simply because we spend more than we bring in. That's another part of this that we have to understand. So as of 2021, the deficit spending is little over $1 trillion, according to the CBO. So what can we do about this? Let's talk about what we can actually do. The first thing is we can optimize tax advantaged accounts. And I kind of hinted at that already. You can't control Washington directly, but you can control your own actions by becoming more proactive. So the first step is to take advantage of tax deferred and tax-free accounts. Tax deferred accounts allow you to reduce the taxable income in the current year by deducting the contributions. What's even more powerful about this is that you don't pay taxes on your earnings, interest, dividends, and capital gains until you take possession or withdraw the money. When you take possession of that money in later years, your withdrawals are considered taxable income. Therefore, you're going to pay income taxes at the marginal income tax rate, which is higher than the applicable capital gains tax rate for a lot of people. So that's something to keep in mind. When you reach the age 72, you must take mandatory distributions, which are also taxed. Some tax deferred accounts are your 401k, your IRAs, your annuities. They require mandatory distributions or mandatory withdrawals. One of the big things you can also do is you may be able to do tax-free accounts, especially with the 401k Roths, which is interesting for a lot of people. In a tax-free account, you never pay taxes on the earnings in the future, but you lose the tax deduction for contributions in the current year. So there's a little bit of a trade-off. So if your income is high, you may not qualify for a Roth IRA because the IRS phases out your eligibility based on your modified adjusted gross income. You may have a tax-free feature in your company's retirement plan, however, which you could take advantage of. And that's usually a better option for you because you can put more money in tax deferred. And there are some companies that you could actually max out both your tax deferred and your tax-free, and you hit the overall maximum, and yet that really can save you a bundle of money in the future on taxes. So it pays to see what your options are, and then you optimize the balance your contributions between the tax-deferred and the tax-free accounts. Also, tax-deferred accounts are great for reducing taxes. It's important to avoid locking in too much of your money in them. So this is something I'm going to talk a little bit more about later in this episode. because you could lose important flexibility if a large portion of your wealth is in IRAs and 401k accounts, because those accounts are not easily accessible without taxes or penalties. So the Roths are better about that, but especially in the tax deferred accounts, you have to be careful with those. So which accounts are tax deferred and tax free? The typical tax deferred accounts are 401ks, 403bs, and 457 plans, and tax deferred annuities. That's typically what's tax deferred. Tax free, it's normally your Roth IRA, 529s, certain types of insurance policies, Roth 401ks, and that is your tax free type of investments. There are some things you can do with other investments like real estate too that could help with your taxes. So now I'm going to move on. So we talked about kind of tax deferred accounts. I'm going to talk a little bit about how to reduce the cost of capital gains. That's a big thing to do in order to beat this whole thing that we're talking about today is beating taxes and inflation. So another strategy you could do to lower your taxes is to focus on investments with lower turnover and a longer time frame, a long time horizon. This generates long-term as opposed to short-term capital gains. So as a result, if you have fewer short-term gains, you're going to have a lower tax bill most likely because short-term gains are taxed as income, which tends to be at a higher tax rate for a lot of people. Short-term gains right now are when you take a gain on something less than a year, in less than a year's holding period. So the accounting method that you use to calculate your capital gains is a big part of how well you will do with this. You can manage that. You want to use the most favorable tax lot accounting to minimize your gains. There are 4 common types of tax lot accounting. There's first in, first out, last in, first out, specific lot, and average cost. So the first in, first out accounting assumes that your cost basis is your first lot purchased. So the last in, first out method selects the last shares purchased to be sold. In specific lot, you could choose the actual lot that you want to sell. And that can a lot of times be the best way for you to deal with it. Not always, but that many times, especially if you have stock options and things like that. And the average cost method is just simply averaging out your average cost. So tax managed strategies. So this is one of the things that we do when we're managing tax managed accounts is we look at that. We have a computer programs that can help us optimize so that you can lower those capital gains tax. That's really important. Having a good accountant is big too. You want to make sure you have a good accountant on this. Another way to lower your taxes is to do tax loss harvesting and replacement. So before the end of the tax year, it's a really simple technique of selling less desirable investments for a loss. So you might have some investments that have not been doing so well that you could take a loss on, and you can offset gains from another holding that you're about to pare back on. So selling only those investments that are not attractive and then replacing those with similar investments, you can replace the investment sold for a loss and then offset those gains, and that really can help. So let's just talk about another way that you could really save taxes. So when you buy fixed income securities or bonds, you might want to look at these municipal bonds. And right now, for many people, the municipal bonds pay you much more than a taxable bond after taxes. So these bonds pay tax-free interest. They can be an excellent investment for high-income individuals. It's a good idea to compare the yields of the tax-free bonds with those of the taxable bonds, and then invest in those that are giving you the better return. So in order to compare them, you have to adjust the bond yields for taxes. The one that pays the highest after-tax yield is better, and all else being equal, you would go that direction. You want to do an apples to apples comparison, looking at the credit quality. It's just like, here's a simple example. If you have a taxable bond that's paying 5%, gosh, I wish we could find those. You can find them, but they're generally junk bonds. But let's just say we have a bond that's paying 5% right now. The after-tax yield, using that same tax rate we were talking about, 28%, it's 3.02% after tax. So you're really only making 3%. So if you buy a tax-free bond that's paying you 4%, well, you're going to be better off, right? After tax, you're getting 4% tax-free. So you just compare that after-tax yield with the tax-free yield, and that could really help. So here's another thing that we want to look at. Okay, when we're trying to save on taxes, one of the ways that people pay taxes unnecessarily, and it really irks me sometimes to see this, is people are paying other people's taxes. And let me explain that a little bit. You may not be aware there's something called the phantom tax. It's relatively unknown, and it's kind of a nuisance, that causes people to pay taxes on capital gains that they never actually earned. What you don't know can hurt you. Mutual funds have potential capital gains the moment you buy them. And if you're not careful, they can burn you. This is one of the reasons why we manage money with individual stocks and bonds, because that helps us to save taxes for clients. So to see if your fund can affect you, check the potential capital gain statistics tracked by mutual fund data suppliers like Morningstar. This figure represents the gains that's already built up in the fund that has not been realized yet, but it is taxable, and you may be the one who's going to pay that tax, even though you came in after that gain was earned. So if a fund has a high percentage of their assets that are exposed to potential capital gains before you bought in, you may have to pay taxes if the fund manager sells the security, right? If they sell some securities at gains, then you pay for it. If the fund goes down after you invested that, say, then it's possible even that you could actually pay taxes on those and even have a personal loss. Very, very bad thing you want to avoid. So to avoid this, put highly taxable mutual funds in non-taxable accounts, or invest in a different fund that is tax efficient, or buy individual stocks and bonds, which is generally what we do. Here's another way that we can beat the taxes. Okay, we're just really focusing in on this. You could put the right investments in the right accounts. This brings us to this concept of asset location. So certain investments generate more taxes than others naturally. For this reason, it's better to put highly taxable investments in your non-taxable accounts. And then you can do the opposite with your lower tax investments and put those in your taxable accounts. So this is called asset location. Vanguard did an interesting study. It was kind of an older study, but it still applies today. Back in 2014, Vanguard did this study, and they were looking at the impact on returns based purely on placing highly taxable investments in tax-deferred or tax-free accounts and locating those investments with lower taxes in taxable accounts, right? So they basically just did what we talked about. And they estimated that this strategy alone could increase your after-tax rate of return by 75 basis points, or 0.75%. So that's, every year that compounding adds up. If you put both types of accounts open and you have a sense into how you could do this, you could actually increase your rate of return simply by making smarter choices in how you do where you locate your assets. Now, there's another thing for those people who are retired that really makes a big difference, or it can make a big difference. And that's how you take your money out, your withdrawal strategy that you take. So when you take money out of your portfolio, you want it to last as long as possible. You want your portfolio to have the best longevity after taxes, and you want to avoid paying unnecessary taxes as you do it. So that's going to help you, preserve your lifestyle, and et cetera. So in order to do this, you have to look at the order which you take funds from, because it has a big impact on your wealth. So certain withdrawals must be taken out annually no matter what. So, and you don't really have control over that. Like your mandatory distributions at age 72, you're going to have to take them out. So, once you've accounted for that, then you have flexibility as to where you take your money out. And once you've exhausted your taxable accounts, then if you start off with your taxable accounts, you can generally withdraw from them first and avoid some unnecessary taxes if you manage it correctly. So I have a little chart, actually. It's a withdrawal order. And if anybody wants this little chart, just shoot us an email, info@wealthnetinvest.com, and I will send you over this chart. It's called a withdrawal order chart. And it's up to date right now as of the way the taxes work now. But basically, it's this chart, a flow chart that says, are you over the age of 72? Yes or no? And then you just flow down, and then it kind of tells you what's the best way to go. And having a good CPA, this is a good rule of thumb to start with this chart, and that will keep you out of trouble. So you want to diversify your tax structure. So as we kind of put this all together, you want to diversify your tax structure so that you have a blend. You don't want to have too much in tax deferred. You want to have some in taxable, some in tax free. And this is going to give you the most flexibility, because these tax rules are constantly changing. That's the other part of this equation, is having diversification in the types of taxable structures you have will give you the best ability in the future to be able to flex and to move in the direction that's going to be better for you in the future. If you optimize, and I've seen this advising clients over the last couple decades, if you optimize your taxes only to what is happening right now with the current tax rules, and you optimize that based on a long-term decision, then you're going to inevitably be wishing you hadn't done that, because those tax rules are constantly changing. So definitely look at that as well. So let me just summarize this with the tax part of it. There's lots of evidence pointing towards higher taxes in the future. We can't control Washington, but we can control our own actions. And I've outlined here 8 basic tax reducing strategies you could use. Number 1, optimize your tax deferred and tax-free accounts. Number 2, reduce your capital gains taxes with longer term strategies. Number 3, tax loss harvesting and replacement. Number 4, buying tax-free municipal bonds, if it makes sense for you. Number 5 is using proper tax lot accounting. That could be a big deal. And number 6, avoid that phantom tax. Consider investing in individual securities. Optimize your asset location strategies. Where are you putting which assets? Follow the order of withdrawal guidelines. And of course, the last is diversification of your tax structure. So if we use these effective strategies, you're going to be able to build wealth faster in many cases, because these rules are constantly changing. It's important for you to work with a CPA, a good investment advisor that's going to help you keep these rules and all of these little nuances in order. One word of caution here, though, sometimes it does not pay to have an elaborate account structure, okay? There's a lot of entities that will sell you things where they try to do something so complicated for tax purposes, like on some loophole or something like that. And then the government closes that loophole. Don't try to be too clever with the tax planning. Try to keep it flexible, because this could cause huge headaches down the road. And, a simple tax strategy in this podcast is going to help you have a great method to start saving on taxes. And let's get back and circle back to inflation now. I've spent a lot of time on taxes because that's something that we can control. We don't have a lot of control over that inflation. The way that we deal with the inflation is that we have to recognize that we're not going to get ahead. We're not going to have strong real returns after inflation unless we invest in equities, real estate, investments that are going to help you beat inflation, that are going to grow faster. And the way you do that, this is a whole nother topic that I want to get into with another podcast. But the way you do that is a combination of having good return strategies, good diversification strategies, good position sizing. So when you have a proper portfolio structure, you should be able to beat taxes over the long run, 10 years, 20 years, 15 years, 30 years, so that you can be ahead of the game after taxes and inflation. That is our primary goal in our business, is to help our clients maintain and attain financial security. And the only way you can do that is to beat taxes and inflation. Okay, that's all for now. If you like this information, if this is helpful, be sure to like and subscribe. Share this with a friend too. If you know anybody who's paying lots of taxes, has high income, or maybe just they're maybe struggling with this part of it, share this with them. Maybe they can get some good ideas. And as always, if you have any questions, just let us know. You can go to www.wealthnetinvest.com and keep in touch with us, okay? And also be sure to make some comments too. If you have any comments, things you want to add, or things that you want to talk about, you want us to talk about.